Hi, my name is Jordan Wilson. When we did our review of the investor profile, one of the things I constantly mentioned was that your investor profile is important because it should directly drive your target asset allocation. And that's what we want to focus on in investing, is creating a target asset allocation that meets your financial objectives and deals with the financial situation you're in, any constraints you have, those sort of things. So today we're going to begin to look at the target asset allocation. The objectives for today are to just look in general at what an asset allocation is and why it should be unique to an individual investor. And we'll finish up with just some thoughts on the assets or the asset classes that should be in a typical allocation. What is an asset allocation? Well, it's the process that investors use to distribute, to allocate their investment capital between various asset classes in their portfolio. The goal is to create a well-diversified portfolio. And we spent some time looking at the concept of diversification and asset correlations and how they're used to effectively and efficiently attempt to reduce overall portfolio risk while still maintaining the level of expected returns. And we'll just go through a few of the key concepts on asset correlations in a moment just to refresh. What are our options when we're looking at an asset correlation? Well, I tend to think that there's three core asset classes: cash, cash equivalent, fixed income, and equities. And we covered, I think, the core concepts of those classes before, and we'll look at them a little bit more detail later. But within those core three classes, there's many subclasses that have different risk and return profiles. As well, you have non-core, also called alternative asset classes. Maybe that's commodities, maybe that's real estate, maybe that's venture capital, private equity. There's a variety of things, fine arts. So you've got quite a wide range that you can put into your asset mix. Diversification, in general, that's where you add different assets to the mix. And by doing so, you can reduce the overall portfolio risk while still maintaining the weighted average expected return. And again, here the goal is to be effective and efficient. To be effective means that you are achieving that goal of being well diversified, reducing your portfolio risk. The efficiency side is, what is the cost of doing that? That could be time, it could be physical cost. So we want to be effective and efficient. And if you remember our look at Investopedia, where it's just by adding another asset to the mix, as long as it's not perfectly correlated, you reduce the risk. Yes, but there's a cost of adding the 1,000th equity position to your portfolio, and it's a diminishing return. We saw how asset correlations are the key concept to diversification. And that's how much two assets will move in tandem. If they're 100% positively correlated, they'll move in lockstep. We discussed two Starbucks kitty corner in Los Angeles. But even there, they're not going to be probably 100% positively correlated because you have different baristas, different managers, Maybe one's in the bottom of an office building, so it gets slightly more traffic. There's little nuances that prevent most companies from being 100% exactly the same. And anything below 100% positive correlation will provide some diversification benefit on the risk. But obviously, the lower the correlation, the better the diversification. And if you have something that moves entirely in the opposite direction, then that would be 100% negatively correlated. And we see the range goes from 1.0, which would equate to 100% positive, to negative 1.0. And the way the formula works, the closer you get to minus 1.0, the better the impact. We also talked a bit about how correlations shift in time, maybe permanent. International equities is a good example. And again, we talked about Starbucks, where Starbucks in I think 1976 or 81 began operations, and they were almost entirely in the US for the first 20 years. Now they're everywhere. And that's the same story with McDonald's, with Walmart. It's a global world. Apple Computer manufactures the majority of its product in China. So as the world shrank, what you used to see was very good diversification by holding even German or Swiss equities. Now you got to look much farther afoot to the frontiers, to the Moroccos, to the Kenyas to get some diversification. So the world has shrunk, and that's never going to reverse in all likelihood. But there's also transitory shifts. And the one example that I like to use is there's a common perception that bonds are an excellent diversifier versus stocks. And that's true for the most part. But if we look back 100 years, actually to the 1870s, we see that the bond correlation with US stocks has been negative in 635 months compared to positive in 1,063 months. Now it's relative, so if you can be positive 0.1 or 0.2 and that still gives good diversification. But the perception over the last couple of decades, since the very late 1990s, that bonds have a negative correlation with US equities doesn't hold true over the long term. Even today, we see that 10-year aggregate or 10-year US bonds are about negative 0.32. Fantastic diversification. But the core aggregate bonds are 0.05. Positive. Close to zero, so excellent diversification. But where will the relationship be in 5 years, in 10 years? So there's really no guarantee that US bonds and equities will continue to be excellent diversifiers going forward. And in fact, if we again look back into it was 1983, we see that the correlation in September of 1983 was 0.88 between bonds and US equities. That's not very good diversification. So we just have to keep an eye on how correlations may move over time and then adjust your portfolio accordingly. I talk a fair bit about unique allocations. One, because I think investors are unique and they need solutions that are unique to them, not cookie cutter, generic, one size fits all approaches. A common approach used to be take your age, subtract it from 100, and that's your equity allocation. It's simple. And if you don't have too many issues, not a bad starting point for a lot of, especially the accumulators, the younger investors. But for most people, there are a lot of issues. And that makes it less than optimal. Even if it does work, you also have issues with all the subclasses. How do you fit in the risk return profiles of all the different equity subclasses if someone just says buy 75% equities? So I think there's a little bit more thought process involved in a one size fits all. And as I said up front, investors are unique. Age is a consideration, but also what's your financial situation? Where are you in the life cycle phases? What are your investment objectives, your constraints, liquidity needs? What's your risk tolerance? So there's a lot out there that you have to factor in. And fortunately, all of that goes into your investor profile. So you've got that one document that just went through all those things. And that makes it useful. And one short example that we can go through is you're 25 years old. The 100 minus age says 75% equities. Fine. What happens if you inherited $2 million that year? Should you put 1.5 million in equities? Maybe, maybe not. There's a lot of other variables in your life. Where did you start? Did you have 5 million from a prior inheritance? Or did you have no assets, but a lot of debt? You just came out of school and you've got 6 figures in debt. What are your other sources of income? Do you want to retire tomorrow or continue working with a goal of becoming CEO of the company? Maybe you just had triplets and 3 times the expenses. Do you want to plan to buy a house in 6 months? Maybe you've got $1 million house that you want to buy now. There's a lot of factors that come into play that make these one-size-fits-all approaches not that good. So fortunately, you're going to sit there and you've got your investor profile, and that will help you. The other area too in that is your risk tolerance. Do you take a rational approach to investing? Are you emotional? So if I am 25 and I have a very low risk tolerance, am I going to be comfortable because a computer or somebody told me 75% of my assets should be in equities? Possibly not. I'm not sure I want to be reaching for the antacids every time the stock market dips because I've been told 75% equities is what I need. And then some people might say the other extreme. No, I want 100% equities because I like the risk. So again, your investor profile is useful to help come up with who you are as an investor, and that will tailor your asset allocation, not just 100 minus 25. If we look at the asset classes, now here's something that sometimes people get, I won't say confused, but maybe annoyed at. I like to think that there's probably 3 core asset classes. There's cash equivalents. That's the lowest risk, lowest return, highly liquid. There's fixed income, which is kind of in the middle for risk return, still quite liquid. And equities, which are the highest risk return, not so liquid. And those are more generic statements. As we've discussed before, when you get into the subclasses, there's a lot of variation within the classes, as well as between the classes. And I think the example that I always raise in these sessions currently is, are Coca-Cola common shares, because they're equities, more risky than, say, a Venezuelan government bond? The answer is no, but equities are riskier than fixed income. You have to look at the specifics, the systematic risks, the non-systematic risks, and assess risk return on an asset by asset basis. So the generics are nice, but you still have to drill down. As well, there's other issues you have to consider within the classes. We talked about Coke versus Venezuela bonds. But you need to decide what type of risk am I happy with? Do I want small cap companies, or only large cap that are highly liquid, trading on large exchanges with lots of issued shares? That's one consideration. I may have specific inclusions or exclusions by country, by industry, even by company. For example, there may be embargoes or sanctions. Some countries currently cannot trade with Iran or North Korea. So maybe you have exclusions from your portfolio that you have to consider. Maybe there's industries that you want to avoid. You're socially conscious, so perhaps there's certain industries like the oil and gas that you'd like not to participate in. Or conversely, maybe you're a geologist or a geophysicist or a petroleum engineer with expertise in, say, Western Canadian junior oil companies. That might give you an advantage in that specialized market. Investment styles, that would be another issue to consider. And by styles, I'm talking more value stocks. Larger, mature companies, I'm probably buying them in large part for the dividend income that they generate, versus the growth stocks, which you likely will not see any dividends. You're buying strictly for their potential capital gains over time. So that would be one example. Another area to consider is domestic versus global. Do I want to invest internationally, or do I just want to stick close to home? Along those same lines, you'll see home country bias. And that's less of an issue for American investors, much more of an issue for Canadian investors. And what I mean with home country bias is the US equity market is plus or minus about 45% of the world's equity markets, capital markets. So if I have a global portfolio and it has no home country bias, then I will see about 45–50% of my investments in America and the rest around the world. In Canada, it is a problem because Canada is about 4% of the global equity markets. Yet the typical Canadian investor in their own portfolios tends to have probably closer to 30% at least invested in Canadian equities. Now, Should you have a home country bias? Maybe there's reasons for it. Maybe there's not. But that's a decision you have to make and understand why you're making it. To me, unless there's a very good reason why, I would want no home country bias, unless I was a retiree who wanted to match my interest income on fixed income side against the living expenses or any debts that they have. And on the equity side, you can make a similar argument for retirees if you're trying to generate dividend income. And the other issue for Canadians on the dividend side is if a dividend is issued by an eligible Canadian company, then it should be eligible for the dividend tax credit, which gives you a lower tax rate versus interest income or non-Canadian dividends. So if I want all my dividend income from the US, then I need to rethink that, especially on an after-tax basis. Foreign exchange, another domestic or global type consideration. Do I want exposure to foreign currencies as a way to further diversify my portfolio? Or do I want to hedge in my position and just have, if I'm American, just in US dollars, or if I'm a Canadian, just in Canadian dollars? Again, there's valid reasons for either approach. And if you look at exchange traded funds or many mutual funds, you'll see the identical fund offered to investors in both a hedged and unhedged position. So depending on what way you want to go, you can hedge or you don't have to hedge. One of the questions that I always get is why fixate on 3 core asset classes? There's a lot of stuff out there. I want real estate in my portfolio. Or I've been told commodities are negatively correlated with certain asset classes, so I want those as well. And that is true. But I think the issue for most mass affluent retail, even up to say $2 million in assets, is the cost to spread out your wealth is something that you want to minimize. You want to keep your costs down. And secondly, people don't have a large foundation of wealth. So I always sort of want the clients to create this strong foundation, this base. And then once there's the foundation, then we can put in, a little bit more exotic assets or engage in tactical allocations. And the big thing that you explain to the clients is that, you want real estate in your portfolio because someone says real estate REITs are good to add. Well, if I'm an American investor and I look, just for example, iShares S&P US Total Market Index ETF, its asset allocation within that equity portfolio to real estate is already 3.2%. Not 20%, but you still have exposure to real estate in a diversified mutual or exchange traded fund, an index fund, nothing even specialized. In Canada, 3.1% of the TSX capped composite index is allocated to real estate. iShares Global ETF, 2.6%. So even just by buying a pure equity index fund, I'm getting 3% exposure to real estate. And in Canada, Brookfield Asset Management is one of the top 10 holdings on the index itself. And if you look at Brookfield Asset Management, it's considered a financial sector, so it's not in with the real estate. But it is de facto real estate. It's also private equity. So this is kind of just Brookfield itself gives you exposure, if you're a Canadian investor, to lots of these alternative classes that you're desiring. On the commodity side, similar. In Canada, I own the TSX Capped Composite Index. 13% of that is what's called materials. And within that, the top holdings are Barrick Gold, Nutrien, which is a potash corporation, Franco-Nevada Mines, Wheaton Precious Metals. You want exposure to commodities? Well, you already got 13% of it just in a bog standard index fund. So by looking at what's in the fund, you often find that just in a generic equity index fund, you do have exposure to real estate, to commodities, to those sort of things. So until you get that foundation, you still get adequate alternative exposure just in a standard equity fund. That's all I wanted to discuss today. I hope you got a feel for just sort of a high level look at target asset allocation. And as we go through this section, we'll drill down a bit to what are some considerations that I would have if I was an accumulator, if I was a consolidator, if I was in the spending phase of my life. And once we get through that, I think you'll better appreciate that there's a lot of nuances to how one would set up their target asset allocation and what might work for the guy in the office or cubicle next to you at work is likely going to be much different than you will incorporate, or the person on the other side of you will, because again, everything comes in off your investor profile to create a unique asset allocation that fits your needs. Thanks for the time today, and have yourself a good one.